Hi there. Today I'm going to talk about mortgage qualification hacks for self-employed applicants. Qualifying for a mortgage these days is generally a cumbersome thing. There's the application process, which is generally a few minutes, followed by a document collection phase. And then it's at this stage where you should then be presented with a pre-approval or pre-qualification of some sort. Sounds pretty simple for the most part, but depending on how your income is classified, it could get a bit complex, particularly for self-employed applicants where the key areas of focus are within the various income tax documents that are requested of them. And what I'm generally referring to are T1 generals, business financials, if applicable, and notice of assessments. It is at this stage where the knowledge and experience of the mortgage broker becomes crucial, as the reality is that not all mortgage brokers or bank representatives understand how to read these complex financial statements, let alone dissect, interpret, and draw conclusions from them. Most brokers or bank representatives typically look for the most recent 2 years worth of notice of assessments and calculate the qualifying income based on this 2-year average. This method works fine if the declared income is sufficient to qualify for the desired purchase. But what if this qualifying income falls short of qualifying the applicant? An experienced broker or banker might simply conclude that the applicant doesn't earn enough income and generate an understated or undervalued pre-approval mortgage qualification amount. But what if the self-employed applicant intentionally declares a lower income for personal income tax purposes? Or what if they declare their income via dividends rather than T4s? Or what if they only withdraw a specific amount of income from the business for living expenses, leaving the remainder within the business where they pay far less tax? As we know, one of the massive benefits of self-employment is the tax strategies that you can take advantage of. But of course, these tax strategies come in various forms and vary from one business owner to another. Therefore, qualifying based solely on the 2 most recent years' notice of assessments isn't a one-size-fits-all method for all self-employed applicants. There's way more to it than that. So let's expand from here and talk about the lesser known qualification boosters that can propel self-employed applicants to higher mortgage qualification amounts. There are 4 particular ones I want to point out. Number 1, the gross up. While self-employed individuals might have a lower taxable income due to their deductions, their actual cash flow or ability to repay a mortgage may be higher. Grossing up provides a way to consider the true cash flow rather than just the reported taxable income. Participating lenders will allow self-employed applicants to gross up their 2-year average declared income by as much as 30%. The declared income amounts are referred from or referenced from line 1500 of your notice of assessment. Qualification booster number 2, using net income after taxes. This can be found within the business financials. Using net income after taxes reflects the financial stability and viability of the business. It further acknowledges that the business has generated profits after covering all operating expenses, tax obligations, and dividends already paid out to the owners. Some lenders will consider up to 60% of the net income after taxes as qualification income. This ledger is often referenced within the statement of income within the business financials. Qualification booster number 3, stated income, also known as no doc or low doc mortgages. Stated income programs allow applicants to state their income without providing traditional income verification documentation such as tax returns and other self-employed financial statement documents, for example, business financials. These mortgages often place a heavier emphasis on the borrower's creditworthiness and credit score and offer additional assurance to the lender, as they are typically backed by creditor default insurance in the event the borrower defaults on mortgage payments. This creditor insurance premium ranges from 3.3% to 5.85% and is multiplied against the mortgage principal, ultimately having an immediate impact on the property equity as it's capitalized into the loan. For example, the premium on a 90% loan-to-value mortgage for a $500,000 purchase would be $26,325, which is a 5.85% premium multiplied by the mortgage principal of $450,000. For a complete breakdown of the scaled premiums, go within the episode notes and link to the blog version of this episode. Qualification booster number 4, most recent 12 months bank statements. This is typically the qualification method used by subprime lenders where applicants have been turned down by traditional AAA mortgage providers such as household name big bank brands. Allowing applicants to use the most recent 12-month bank statements also circumvents the requirement to verify that all personal taxes are up to date and paid in full. This qualification methodology often yields the highest interest rates as well as a 1 to 2% fee that is deducted from the mortgage advance, proportionally increasing the cash to close as a result. To conclude, please be aware that the specific rules and guidelines discussed in this video can vary among lenders and mortgage programs. The ability to take advantage of these methods ultimately depends on the analysis of the tax returns, income statements, balance sheets, and other financial statements. Additionally, credit scores, property characteristics, and loan-to-value ratios also play an important role, which for the sake of time I didn't discuss in this video. So as always, to get a more accurate and complete assessment, a full application and complete document collection are required to generate your qualification possibilities. To get started with your pre-qualification, link back within the description notes for this video where you'll find my contact information and online application link. Thank you for tuning in. Talk again soon.